Federal Reserve is in focus this morning. We are awaiting the release of the Fed minutes. We are looking for insight on the central bank's decision to keep rates steady and also what the Fed is thinking when it comes to winding down the $4+ trillion balance sheet. Joining us right now is Merrill Lynch and U.S. Trust Vice Chairman and Head of Investment Solutions Group, Keith Banks. Keith, it's great to see you this morning.
Good to see you, Mary.
How important is the Federal Reserve news today, and what are you expecting we'll hear?
I'm not sure today is going to be overly insightful. I think what happened literally was the Fed was spending too much time, arguably, worried about wage inflation and what that would do in terms of driving overall inflation. And I think what we've seen is they've since reconsidered that. As you said in your intro, Maria, the big pivot was one of the major catalysts for why the market went from where it was in December to where it is today, up 11.23%.
But we're wondering how slow the economy really is. Earlier, we had Jerry Storch on, who used to be the CEO of Toys R Us, and he said, don't believe that retail sales number last week. Actually, the economy is running pretty strongly. And so does that threaten this whole pivot idea?
Well, you know, we agree the economy is healthy. We think you're going to get, between 2 to 2.5% real growth this year in the economy. But we don't think that level of growth is going to take inflation to a level that will concern the Fed. So we think inflation will stay below their objective of 2%. I think it's around 1.7, 1.8% now if you look at the PCE deflator. So we need to see the economy healthy to justify the earnings growth expectations that are in the market right now. And I think the Fed, as they said, they'll watch the data, they'll be patient, and we'll see how the year plays out.
Keith, I'm glad you're bringing this inflation point up because we're seeing it a little bit in the average hourly earnings. But the problem, I think, with the Fed is the asset inflation. And they've talked about this numerous times. They're talking about asset inflation and possible bubbles. Do you think that's what could make the Fed move in the second half of this year to raise rates as they've indicated?
No, it's a good point. I think if we see the markets continue to move, our own forecast from our CIO office as well as Bank of America Merrill Lynch research is we can move toward a 2,900 toward the end of this year on the S&P. If the markets continue to do well and we get 2.5% growth, will the Fed kind of sit down again and say, is it time to move further toward normalization? Possibly. I'm not sure at that point in time that will be a real big negative for the markets if earnings are coming through, if it looks like we're going to get a reasonable 2020, which we think we will. So there's, as you know, there's a lot of ingredients that go into the cake, and I think you just have to sort them all out to figure out what the implications of any one move might be.
Keith, how about the unwind of the balance sheet? Right now it's about $50 billion, or it's automatic at $50 billion a month.
Right.
And we're hoping that we see something in a minute that sheds light on whether or not they're going to reverse that. If they do slow down that pace, do you think that changes the dynamic in the capital markets at all?
I don't think so. I think what the capital markets want to hear and see, it's just not on autopilot, that they have the ability, depending on what the data tells them, to slow that down. I think the initial thought was we're doing 4 rate hikes, and, oh, by the way, the balance sheet unwinds on autopilot, so there you go. Right. I think, and a lot of people believe, and I think, Maria, you may have said it, that the end game is $3.5 trillion to $3.7. You can get there by the end of this year in a very natural way. So I don't think people are going to be overly wound up unless they indicate for some reason they feel a need to accelerate that, which we don't see.
So how do you want to allocate capital right now?
We are still overweight equities. We made some shift last month. We reduced our exposure to developed international markets just because Europe has got issues right now. So we're overweight the U.S. We're overweight large cap, still very diversified. And, our feeling is that as the economy demonstrates it will grow in that 2 to 2.5%, and you see earnings following, the equity markets will outperform fixed income. But stay with high quality. We like large capitalization stocks. We like companies that have cash flow, little debt, and pricing power. Because I think as you get further into the cycle, by mid-year this year, this expansion will be the longest in history. Will eclipse the 1991 to 2001. So you just want to be cognizant of that, although we do think this can go on for a while.
It's interesting stuff. Europe, they're talking about 1% growth for the economy of Europe. You're right about that.
That'd be a good
Germany
thing for
was
them.
marginally
that would be a good
out of a recession. It was like 0.3%.
Exactly. Keith, it's great to have you on the program.
Always a pleasure. Thank you.
Good to see you. Thanks so much. Keith Banks joining us there.